First off, are we in for another crash? Have we started the new crash? Well, here's the deal. There's only two ways to get a stock market crash. And once again, you can look at the past 100+ years in the stock market. I've looked at every single crash, and every single crash was because of one of two reasons. You either had major recession coming or occurring during that crash, right? Or you had the Fed raising interest rates. It's one of those two scenarios, and that's it. People make the financial markets and the stock market much more complicated than it has to be, right? They overcomplicate it, and I think sometimes it's just natural human tendencies to want to overcomplicate everything in life, right? We overcomplicate, and at the end of the day, like, you could just boil things down in life to, like, do this action and you're going to get this result. Instead, we make things so complicated, including the stock market. And like I said, go through every single stock market crash the past 100+ years, and you will find every single one of them was because one of those two reasons. There's never a stock market crash that ever occurs in which one of those reasons is not present. It has to be there to get a stock market crash. Otherwise, you can't have a stock market crash. You can have corrections where the S&P will go down 5, 10, 15%, whatever, but you can't get that 25%, 35%, 45% type crash unless one of those two reasons are present. Other than that, you're just going through volatility. And good examples of this would be 2008, right? Major recession was coming, right? Things started to weaken considerably, and I'll show you the data around that in just a moment. And exactly, if you're trying to look at timing and whatnot, how to kind of get ready for something like that, right? 2020 was another great example, right? The Rona crash, like, the whole worldwide economy is going to close. We're going to go into a major recession. So both of those were great examples of that. And then in recent times, as far as Fed raising interest rates for some stock market crashes, right? The Volcker era, if you look back at the summer of 1981, for instance, the Fed had raised, Paul Volcker had raised interest rates to around 20% Fed funds rate, 20%. Nowadays, we can't even imagine that. Like, we think of 5% Fed funds rate is insanely high. 20% is beyond ridiculous, right? So there was a whole stock market crash that happened back then, right? Then you could look back at the 2000 crash, right? Fed starts raising interest rates, boom, whole market crashes. In 2022, Fed starts raising interest rates, whole market crashes. It's the only way you can get a stock market crash if you have one of those two reasons present, okay? Now, check this out. Let's talk about number two first, right? The Fed, before we talk recession. Is there a possibility that in 2025, the Federal Reserve starts another hiking cycle? Which, once again, when the Fed starts a hiking cycle, you can get an actual stock market crash. The answer to that is no. No. We do not have nearly enough inflation in the economy to get another Fed hike cycle now at this point in time. I would put it, there's always a possibility of everything, but I would put it at less than a 1% probability the Federal Reserve raises interest rates in 2025. Less than 1%, okay? So what we're in right now when it comes to Fed and what they're up to, we're in a cut cycle or a stagnating cycle. And so essentially the Fed will cut rates, then they might worry about inflation a little bit, and then they'll stagnate for a bit. And then inflation will get to kind of numbers they're looking for, and then there'll be some sort of economic worries, and they start cutting again, cut, right? So this is a sort of cycle we're in now at this point in time. For the Fed to raise interest rates 3 years from now, or 2 years from now, or 5 years from now, or 20 years from now, that's anybody's best guess. But in 2025, this isn't happening. So we're not going to have a stock market crash based upon the Federal Reserve raising interest rates. That's just not happening, okay? Which means if we're going to have a stock market crash in 2025, it's going to be because recession is coming and occurring right now in 2025, right? So you have to begin to look at data. Do we have the data to support something like that? Well, if you look, the unemployment rate is just not showing any significant signs of bumping up right now, okay? You're going to need the unemployment rate to start spiking month after month after month for a while. And when I say a while, I'm talking for several months. The unemployment rate's going to have to spike. You have to see major jumps in unemployment claims to be able to essentially get a real, the recession's here, it's coming, it's hitting, big unemployment cycle, all those sorts of things, right? Now check this out here. If we look back to the great financial crisis, for instance, right? You really started to see major jump ups in regards to the unemployment rate. Really in Q2 2008, right? In Q2 2008, you started to really see like major spikes. At first, no one really took it serious for quite a while because they looked out there and they're like, okay, yeah, unemployment rate's going up a bit, but it's just kind of normalizing. We should be around 5% or so. This is nothing crazy. Q2 2008, you started to see some major spikes up rapidly, right? And by the time you got to Q3, people start to say, you know what? We're getting month after month after month, unemployment rates spiking big. We start getting concerned. And that's what I'm going to show you what happened in the stock market starting at that particular time. And we stopped getting the spike, like the major jumps in regards to unemployment rate, really at the end of Q1, going into Q2. And by that time, any moves up in the unemployment rate were just very minuscule. And then we actually peaked shortly after that and started to go down. Okay. And so what does that mean for the stock market? Look at this. This is from the last month of Q2 2008 to the last month of Q1 2009. And what we saw is we watched the Russell 2000 go down 50%. We watched the S&P 500 go down 50%. And we watched the NASDAQ go down about 47% during that particular time. Absolutely brutal stock market, right? So we need something like this to happen in order to talk about getting a major crash. Or something that, let's say maybe it's not this severe when it comes to unemployment, but something like up here, you could get a 20-30% pullback, a crash in the S&P 500 if that was to happen, right? And yeah, it's not as crazy of a crash as you got in the great financial crisis where the market fell 50%, but still a 25-30% crash is very painful, as we all experienced back in 2022 if you were in the market back then. So here's what we're looking at, right? Whenever I think about unemployment rate, I like to say, are we seeing significant bumps up month after month after month? We don't have that yet. We don't have that. So that could come down the road, but we just don't have that yet. Next thing I like to look at is, let's say people are getting fired, right? Can they go get another job somewhere else? And so that's where you want to look at the United States job openings over time. Now, we know there's going to likely be a lot of government jobs cut over this next 3-month span. You're going to see it in the February numbers when those come out. You're going to see it in the March numbers when those come out. And remember, these all lag by a little over a month, so it takes a time to get it. So you'll see it in the February numbers, you'll see it in the March numbers especially, in my opinion, and you'll see it especially in the April numbers, okay? February would just be the start, but I think you'll see the big numbers really in March and April. That's my personal opinion in regards to government job cuts, right? Now, the great news is job openings is still in the many millions. Okay, so the moral of the story is these government workers should, in theory, be able to find job opportunities in the private sector. Okay, that doesn't mean all of them are going to find jobs, but a good amount of them should, because we still have a lot of job openings out there, right? But the thing I'll say is we're playing a higher game of poker now at this time. And the reason being, job openings have been dropping significantly the last 3 years, really, now at this point in time, right? So this essentially means that if job openings, let's say the government jobs get cut over the next few months, right? And let's say the economy weakens more, you could see job openings continue to drop throughout 2025. Now, that wouldn't in itself cause a massive crash in the market, right? Because that's not like a guarantee. You got to see the unemployment rate going up significantly, big sharp spikes up month after month after month. But it would be concerning to me to kind of look out there if I saw job openings continue to drop. Because that's the biggest problem we had in the great financial crisis, for instance, is people lost jobs and then they had so much trouble finding another job. And if they did find another job, it was like, working at Taco Bell instead of making like, good money as a realtor or something like that, right? So that's something to keep an eye on. So the thing I'll say about this is when it comes to job openings, we are not in danger territory yet. However, if we see a continued deterioration in these numbers significantly, and let's say we all go all the way down to like 5 million job openings or so, that's when I start to fear. And that's when I start to look out and I say, ooh, that could be actual real trouble for 2026. But for right now, it's just like, keep an eye on it. Like, we're watching, we're seeing what's happening here, but it's not going to tell you like, oh, the big one's coming or something like that, right? And so the moral of this story is very difficult to get an actual stock market crash in 2025. Not impossible, but once again, to have a massive unemployment recession hit this year or to have a Fed hike cycle, very difficult. And like I said, the Fed hike cycle, throw that out. That's, like I said, that's like less than a 1% probability. So the only way you get a stock market crash is if you have the economy completely fall apart and the unemployment rate spike up massively month after month after month for many, many months in a row. Then we could talk about then we can talk about an actual stock market crash and not just a correction in the market. That's tough, man. It's going to be tough to get that this year. Like I said, if these numbers keep trending down throughout 2025, then we could be talking about something coming in 2026. But time has to play out there, right? And a lot of people like to rush these things, and it's like the whole game has to play out. Time has to play out here, right?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area.
Alrighty, next one up here. Let's talk about markets and rate cuts.
Markets have been reacting to tariffs on Mexico, Canada, and China. A key question for investors, how will the Fed react? Our Steve Leisman takes a closer look at that this morning. Morning, Steve.
Hey, good morning, Carl. Fed Fund futures on the move, responding to tariffs by President Trump by pricing in rate cuts from the Fed much more aggressively. Markets now pricing in 3 cuts from the Fed this year with a greater than 50% probability of a first cut in June, a second one in July, and now a third one in September. But will the Fed come to the rescue, and how quickly? Fed officials have said they're going to respond to weakness in growth and employment, but they can only do so if inflation is headed to the 2% target and inflation expectations remain under control. But 5-year inflation expectations measured by the University of Michigan, well, they shot up recently to 3.5% on those broad tariff concerns among the American public. That's the highest level in 31 years. Market-based expectations are lower but remain elevated. Krishna Guha of Evercore ISI says the road to a June cut runs through this. Moderate tariffs, that would mean backing off the current levels against Mexico and Canada, weaker job growth and declining inflation, along with contained inflation expectations. Markets seem to be betting on that scenario, but the Fed could find it tough to cut while tariff-induced price hikes are working their way through the inflation indices, and until it's clear to policymakers they face one-time price hikes, not a rekindling of inflation. Guys?
But the problem, Steve, is that inflation, as you know, is not really demand-led inflation that the Fed fights. So it feels to me that it's easier for them to cut if we really start to see growth slow down, and particularly that have an impact in the labor market.
Yeah, that's right, Sarah. The trouble is that you can come to one conclusion if you sort of close one eye and look only at one part of it. The trouble for the Fed, I think, right now is the context. You know, they go back to 2018, and you see that the tariffs didn't cause a broad increase in the price indices. Well, inflation was below target then. We'd been through a very long stretch of below target inflation. Right now, if you listen to some Fed officials, they point out, hey, we've been through just a pretty good round of inflation. We're still above target. And so that context is going to give them, I think, a little more pause, suggesting to me the market might be a little more aggressive. You're right. They can respond to weakness, lower job growth, but they're going to have to wait till at least they're sure, I think, these price hikes that coming from the tariffs just are one time and not rekindling of an inflation cycle.
So one of the big things with, how many times the Fed cut this year is it also comes down to how much do they cut? So let's say they do a cut in June. Are they cutting 25 basis points? Are they cutting 50 basis points? Are they cutting 75 basis points, right? And are we going to make it all the way to June? I think that's a big debate. Are we going to make it all the way to June without the Fed cutting? Okay, let's say this market doesn't really come back in the short term. Let's say it weakens more. Let's just throw that out there. You think the Fed's not going to come to the rescue and do a rate cut in April or May? I don't know about that. I mean, if the market continues to weaken, if GSG continues to go down, if inflation numbers continue to come good, and let's say we get some actual, like, real economic weakness in some of the numbers over the next month or two, I have a hard time believing the Fed's going to wait all the way till June to do a cut. So it's going to be an interesting whole situation as to watch. And then how does the market react to that? Are they going to get freaked out? Like if the Fed cuts, this spring, let's say, for instance, is everybody going to freak out and think, oh my gosh, we are actually headed to a big recession. The Fed's doing emergency cuts in the spring. So we'll see.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area.
That leads me to talk about the 10-year Treasury. 10-year Treasury falling off a cliff. Like, guys, this is like, straight off a cliff. When it comes to a Treasury yield moving down that quickly, that fast, in a matter of a week or two, that's dramatic, okay? So there's big things happening here. I mean, big things. There's big things happening, and that has ramifications for the stock market, right? I received this text message today, right? Says, from a friend. It said, one of my customers just called and said he got doged. We're going to start calling it doged, I guess, okay? They were about to get $10 million in grant money for this factory in a state. They are starting, and now it's been put on hold. $2 to $3 million of equipment would have been purchased from my friend's company, right? And I said, dang, that stinks. Yeah, it could be a lot of this over the next 12 to 24 months, right? This Doge situation is actually causing a lot of real recession fears. The 10-year Treasury keeps going down because people are starting to be scared about Doge making such an impact that it's actually going to potentially cause a recession, which will then cause the Fed to lower the Fed funds rate considerably and keep the Fed funds rate low for potentially years to go in the future. And so the 10-year Treasury is starting to show real weakness because there's true fear about this starting to play out, right? I'm sure you guys have seen the headlines, right? Trump administration shifts to the next phase of large-scale cuts to federal workforce. Federal agencies told to submit reorganization plans, prepare for mass firings, right? Doge is playing out, right? Now, here's the deal, okay? And by the way, this might be a great thing long-term for the United States, but there's no doubt, and this might be a necessary thing, to be quite frank, for the United States long-term, but there's no debating this is going to be a lot of pain short-term here. Because I'll put it to you like this, right? And I just want to kind of play this out so everybody can kind of, wrap it. I always want to try to explain things in the simplest way possible so everybody can just wrap their head around what's actually going on here, okay? So, worker gets fired. Government worker gets fired. They got doged, right? Okay. So what happens to that worker after they get fired? Well, now they're out of a job, so they're going to have to cut their spending, right? Until they find another job, right? Or they start a business or something like that. But let's be honest, a government worker, they're not starting a business. They're going to try to find another job somewhere, right? So Now, it would usually be natural for a government worker to go find another government job, right? Because if you're kind of in that realm of working for the government, working for a state, working for the federal government, whatever, you're going to probably find another job that's in that category. But here's the issue. You're not going to be able to, because right now the government's not really looking to hire folks. They're looking to fire folks. So if you're going to find a job and you're a federal worker that just got fired or a government worker that just got fired, you're going to need to find it from the private sector, okay? So here you go. You're going on your job search. Let's say you made $65,000 a year, in your government job, right? So now you're going to the private workforce and you're going to try to find a company that's going to hire you, right? So let's say some people do. They find a job that pays $65,000 and has the same benefits that the government job had. Boom. Okay. So now they can resume spending. It's all good. So they had to cut spending for a little bit, maybe for a few weeks, maybe for a few months while they were out of job. Which, by the way, that does hurt the economy in itself. But eventually they find a job that pays the same and boom, they start spending again. But some workers are going to not be able to find a job that pays that $65,000 if that's what they were making, right? And so some worker finds a job that pays $55,000, right? So they're like, oh, I'm glad I just found a job. It pays $10,000 less a year. Maybe it has less benefits, but you know what? I need a job. I got to pay my bills. So that person's making less money. Now they're going to spend less money in the economy, right? So let's say before that person went to Texas Roadhouse each week, right? So now they can't go to Texas Roadhouse anymore. Sad story, man. They can't go get those dang biscuits. They can't get the rack of ribs. They can't get a big beer. Sad, right? Now, some people aren't going to be able to find new jobs. They're going to probably apply, and they're going to be like, nah, we don't want you, government worker. You're not good enough to work in the private sector. We don't want you, right? So you're going to have some people that can't find a job, which means they're not even going to be able to spend money in the economy, right? Because they're going to be out of job for 6, 12, 18, 24 months. It's going to be a while for some workers because, some people are just going to be like, no, you're not it. We're not interested in you, right? Which then leads to a situation where, the guy can't go to Texas Roadhouse. So that causes Texas Roadhouse to not have as good as numbers, right? And then Texas Roadhouse says, you know what? We don't need to build quite as many Texas Roadhouses. So then the construction companies cut jobs because they're like, oh, we don't need to build as many Texas Roadhouses now, right? And then it leads to less orders of all the equipment and restaurant equipment. You see how the dominoes start to play out here? It's a whole game of dominoes. Now, the great thing for Texas Roadhouse, arguably the strongest restaurant chain in the whole United States of America. So they would probably just keep building restaurants even if their sales drop. But they're a one of one, right? They're a free company. The moral of the story is here, this is how the dominoes game plays out, right? Somebody loses a job, it causes short-term pain, and it might cause medium-term pain as well, right? And then that slows construction jobs, right? That slows orders, which hits back to companies, right? It's a whole chain of events that you guys got to understand. And so this Doge situation, when Elon did the whole thing with Twitter, right, with X, and he cut all those employees, right? People are looking at that and they're like, hey, Elon did that with X, he did that with Twitter. Like, that's great. He's doing it with the government now. Yeah, here's the thing. Twitter has hardly any employees, okay? So when you cut those jobs, it's not like that's going to tank the economy. Who's the biggest employer in the United States of America? It's the government. So when we're talking about you're going to cut massive amounts of jobs and you're the biggest employer, the jobs cut at Twitter doesn't matter. It doesn't matter. It's such a small amount. You cut massive quantities of government jobs, the biggest employer in the United States of America. Now we start talking about that actually negatively affecting the economy and actually causing a domino effect for these dominoes to start falling one on the other and another, right? And you get a whole chain of events that start to go bad, and it goes way beyond just government's cutting spending, because then it starts to actually hurt the private sector. And then you start getting job losses in the private sector, right? So this is it's a very high stakes, dangerous game that is going to be very difficult. Okay, very, very difficult.